It's Monday, November 5th. Welcome to Market Foolery. I'm Mac Greer, and joining me in studio, we have Motley Fool analysts Emily Flippen and Jason Moser. How are we doing this Monday?
Hey, hey.
Doing wonderful.
Good. That's all I can ask for. We've got lots to talk about, and we're going to kick things off with the world of Warren Buffett and Berkshire Hathaway. Third quarter operating profits doubling. Jason, strong numbers across the board here with their insurers, their railroads, their manufacturing companies, and Buffett buying back $12.6 billion in stock. What does it all mean?
Well, I think it means that he really likes his company so much so that he wants to buy back more and more stock. But I mean, that makes a lot of sense, really, because we quarter in and quarter out talk about the merits of Berkshire Hathaway's business model. I mean, you keyed in on it there across the board, and you started talking about railroads and energy and insurance. And, I mean, they make their money a number of different ways, and I think personally, it was really interesting to see earlier in the year, they essentially lifted that benchmark that they had set for share repurchases. I mean, they I think were setting this little internal benchmark of 1.2 times book value as this arbitrary target. That's where they felt like perhaps it represented a good return. And now they basically are just saying anytime they feel like it really is sensible to do so, they're going to do it. And I think they have, we can trust their judgment. I think they've earned our trust here. And so it makes a lot of sense to see them continue buying back that stock. I wonder sometimes if they're ever going to pay a dividend. I do feel like there are a lot of shareholders out there that would like that, the cash in the pocket. But repurchases do have a material effect, and the stock has done pretty well over the course of time. So
I've always felt differently about share buybacks. It's always made me wonder, what is a company doing with that capital if the only thing they can think of is buying back their own shares?
Aha.
But I will say, in Warren Buffett's case, I think there's something to be said about diluting the value of the brand. If you're taking, what was it, $900 million, almost $1 billion worth of share buybacks and just throwing it at any investment, right? I mean, at some point, people are going to take that name, backed by, Berkshire Hathaway as kind of less than what it's worth today. So while it's not my favorite thing to see, I will admit that it does increase shareholder return, and it's not a bad thing. So it doesn't really change the needle for me.
But to Emily's point, Jason, a lot of companies, when they buy back shares, they're not getting that right? It's not always a bullish sign.
Well, I mean, we definitely have data that shows that, in fact, most of them get it wrong. And when those share prices are high and they are buying that stock back, but when the you-know-what hits the fan and everything starts coming down, they tighten those purse strings very quickly. And really, if you know your business well, then that's the absolute time you need to be accelerating those buybacks. So we do see that data that shows most companies do get it wrong. And again, I think that Emily makes a great point there. You have to wonder, is that money not better served elsewhere? And I mean, I think the old argument of the dividend is a good one, because a lot of people love to get that cash in the pocket, right? And cash in the pocket is real. Repurchases typically do help the share price over time, but they are somewhat subjective. I mean, there is no rule that says the stock market then must bid that stock up accordingly so that it reflects those share repurchases. So it's always something to consider. It's company specific, and I don't think you just take it as always a good thing no matter who's doing it. I think that you have to look at his stake in Apple. I think that's something that, what is it now, $50 billion I think they have in Apple, which for a guy who said he wasn't really ever going to invest in tech.
That seems like an investment in tech.
That seems like a little bit of a statement, right? And I mean, we look at this sell-off here that's happening with Apple over these last couple of days, and that's real, I tell you. I mean, they're trying to change the conversation a little bit there and move away from being just the phone company and now being more than just the phone company and services and whatnot. But I do think that he is looking for businesses like that, and he'll continue investing in those as well.
Okay, so let's wrap this up by talking about another way that Buffett could deploy some of that capital. I want to get each of your thoughts on what Buffett's next big acquisition could be. Now, we know he's buying back shares, but over the years, we've speculated about different companies. And Jason, any thoughts on who Buffett might go after?
Yeah, I've said this just time and time again.
Say it again, Jason.
I feel like just a broken record here. But McCormick, to me, is I just don't understand how this hasn't happened yet. And I mean, really, at this point in the game, I mean, McCormick's a $20 billion company, and they just digested a pretty big acquisition not too terribly long ago.
$20 billion for Buffett, that's chump change.
That's
right?
Also, he's going to have to pay more than that. I mean, but still, I mean, that would be basically chump change. But it would just be it's such a Berkshire Hathaway style business to my mind. And I think we were talking about this on Motley Fool Money this week too, right? About how the Kraft Heinz numbers aren't looking all that encouraging. We know that Berkshire Hathaway has a connection there. And to me, it was just like, man, McCormick's been going the other way, big guy. Maybe now he'll finally take a closer look, because McCormick is doing a lot of things right, and they really have brought that RB Foods acquisition into the family. That has panned out nicely. So it's a bigger company now than it was, a year ago.
Emily, what do you think?
Well, I like a little Berkshire in my tech. Whether or not that's realistic to happen, you're going to think that you have two Jasons on the show after I say this. But I would love to see Berkshire go after a company like Teladoc, somebody who's revolutionizing in the healthcare space.
Did Jason pay you to say that?
We didn't talk before this. I was actually surprised Jason didn't bring it up himself. So it's a very techie company, but I think it's long overdue some activity in the healthcare space for Berkshire.
For years, I have wanted, I don't think it's going to happen, but I have, of course, wanted Berkshire to buy Costco. Charlie Munger, the vice chairman, is on the Costco board, but Buck Hartzell, one of our colleagues, and I were talking beforehand, and he kind of foo-fooed the idea, said, Buffett, not huge on retail, so maybe that's just a pipe dream.
But is that even retail now? I mean, I work with me here, because that is one of those great membership businesses out there that we love those membership models. And really, it's 3 minutes into the show, retail,
and I had not mentioned Costco, no mentions of Costco or Teladoc for the first 3 minutes. No, I agree. I don't think it's just retail. It's more of an experience.
It is. I mean, and to that point, I mean, they have relationships with travel agencies and insurance companies and whatnot. So you do get a lot out of that membership, and it's a big company, $100 billion company now. That would be a big acquisition. They could do it, but that would be a big one.
I like the McCormick thing, though. I think I would go McCormick, and I bet he would go McCormick before Costco.
Now, don't get me wrong. I'm happy to just let my McCormick shares just sit there and keep on appreciating in value over time. I mean, I'm just saying, if I was there in the Berkshire boardroom, I probably would have lobbed that across their radar once or twice.
With maybe a Teladoc mention as well. Okay, well, let's move on and let's talk some Lowe's. Lowe's is closing 51 underperforming stores. That's 20 in the U.S., 31 in Canada. Now, Lowe's still has north of 2,000 stores in North America. So, Emily, still a big company, but what's the story here?
Still a big company, still the number 2 player in the DIY kind of home improvement space. So I don't think we're seeing a Sears here. I don't think we're seeing all store liquidation. But it is always interesting and concerning to investors when you see store closures. I think what's happening is that they're finding they're just oversaturated in this space. So they have more stores than their largest competitor and the number 1 player in the space, Home Depot, and they're doing less in sales.
So Lowe's has more stores than Home Depot. You shared that with me before the show, and that really caught me by surprise.
It caught me by surprise too, but I think when you think about the person who's going to a Lowe's, I think Home Depot tends to go more towards semi-professionals, contractors. Lowe's goes towards the you or the I's, right? The local people. You just need to go somewhere and pick up something that you're not going to be able to order on Amazon.
You're saying I'm not semi-professional.
Not yet. But you could be if you applied yourself. I do think that was the reason why they had a lot of stores, though, right? They had to make it convenient. So pulling back these underperforming stores, making it closer to the number that we're seeing from Home Depot, I don't think this company is going to be the macro trends here are too strong for the company to underperform. But I do think it's really interesting when you look at their new CEO who just came on earlier this year. Marvin Ellefson came on from JCPenney, where he served as CEO, and did some very similar things when he was CEO of JCPenney, closing down stores, cutting some SKUs, right, making the inventory a little bit less. So it's interesting to see him taking the same stances here at Lowe's. I don't necessarily think that, like I said, that's going to go the same way as JCPenney, but it is interesting to see the same strategy that didn't pan out for him at JCPenney being applied here at Lowe's.
If you loved what I did at JCPenney, Jason, what do you think?
I've always found Lowe's and Home Depot to be kind of like the drugstore space, like the CVS and Walgreens, to the extent that they always seem to be sort of right near each other, and you just go to whichever one is more convenient, really. Yeah. But with that said, I do find myself going to Home Depot much more often than I go to Lowe's, and a lot of that is because the service is better. They have more stuff, and I just always know I can get what I'm looking for there. So for me, I mean, there's no reason, there's no secret why Home Depot has been so successful for so long. I think that Lowe's probably can continue to do just fine because, as we've talked about before, they've latched onto this terrific market opportunity that appears to be pretty Amazon resistant. And as they continue to grow out that internet business, I mean, even just incremental improvements can ultimately result in gold for shareholders.
So as we wrap up here, let's talk about a few of the numbers. Home Depot's market cap of around $210 billion, Lowe's around $80 billion. Home Depot, we mentioned this earlier, but their revenue around 50% larger than Lowe's revenues, and Home Depot much more profitable. When you look at the two stocks, they have both beaten the market over the last 10 years. Home Depot especially has crushed the market. How about going forward? What do you think about the two stocks? Do you have a favorite?
So I think that Home Depot definitely has a premium applied to it right now. So they had about $100 billion in sales. Lowe's has about $70 billion in sales. So the change in market cap there and on a sales basis is pretty extreme. But I think that it's the better company when you look at how it's performed, when you look at the management, and when you look at some of the incentives that they put in place for customers to be return customers. They've done a better job pushing a pro program, customer loyalty, pushing online sales. So for me, that's a hands down Home Depot, but it doesn't make me necessarily believe Lowe's will be a bad investment. I would just choose Home Depot between the two.
Yeah, we were talking about that basement project that we had done in our house, and the company that came in and did it got all of their stuff from Home Depot. I was just astounded at all of the stuff. I mean, and they speak very highly of it. Their pro program is just something they use consistently. So I feel like, yeah, Home Depot is the obvious winner in the space. Now, with that said, I think there's the opportunity for Lowe's to perhaps outperform if the changes they make take, right? I mean, if they really are able to become a bit more like Home Depot, really, I guess is what they ultimately have to do. If they can do that, perhaps there is the opportunity for that stock to outperform. But I feel like Home Depot's the no-brainer, right? I mean,
it's tough,
yeah,
but a lower bar for Lowe's,
exactly, right? Exactly. And then that's why not own both? I mean, maybe that's the way to go. Yeah.
Our final story. This is one that I was not expecting to talk about today, but SeaWorld reporting better than expected quarterly earnings, attendance up almost 10%, revenues up more than 10%. Now, Jason, when I think SeaWorld, I'm going to tell you, I think about the documentary Blackfish. Blackfish was this very critical documentary about SeaWorld and about their whales in captivity. Came out in July of 2013. SeaWorld stock back then trading around $38. A year ago, SeaWorld stock trading around $10. Today, shares back up to $25. So SeaWorld appears to be coming back and overcoming some of that.
Yeah, I would say you'd want to be probably cautiously optimistic here. I mean, it has been a tremendous turnaround. Now, with that said, I mean, I look at SeaWorld and I feel like when you look at that park space, I mean, we talk about Home Depot and Lowe's and kind of going with the obvious one there. I mean, we look at SeaWorld and you have to compare it to probably Disney. And I mean, why aren't you just going with Disney in that case? And chances are probably most people are. I don't think my problem with SeaWorld is, while it's unique, and I think they've managed their way around that Blackfish crisis
you really
well
think so?
enough. I mean, I think
that documentary was so jarring that I'd only gone to SeaWorld once or twice. I'll never go to SeaWorld after seeing that
Perhaps. And I
documentary.
mean, I don't blame you for that. And I mean, I haven't been to SeaWorld. I think I've been once in my life. And when we were down there with our girls in Florida, it never even came up on our radar. I mean, that was just not something they wanted to go to. But clearly, people are going to SeaWorld and their own properties. I mean, it's not just SeaWorld. They own Busch Gardens and other parks around the country. But with that said, I don't think that they possess the ability to raise prices on those tickets like something like Disney. And remember when we talked about Disney back in the time of the Great Recession, and even Disney had to resort to cutting ticket prices a little bit to get traffic in the door, because that's really the most important part of it all, getting people in that door. SeaWorld, I just don't think they possess the same ability to raise ticket prices when economic conditions allow for it. And Disney's been taking advantage of that every year. SeaWorld, they don't have that same ability. And that's got to be concerning, particularly when you look at their balance sheet, which has a pretty healthy slug of debt on it and a coverage ratio really of just about 2. You want that number to be a lot higher. And so there are a lot of hurdles for them still to clear.
And I should add that they have said that they're phasing out the killer whales in captivity. But that brings up another point, because that's in part what they were known for, Emily. So if they don't have pricing power, and if the killer whales are going away, which I think a lot of us think that's a good thing, especially if you see this Blackfish, it is brutal, and I will just tell you, there's a scene where a mother gets separated from her calf, and I'm like, wow.
Yeah, that's going to tug at my heartstrings.
It's brutal. It's brutal. So if you take the whales out of the equation, and to your point, Jason, they don't have pricing power. What is SeaWorld?
So I like to think about these types of things split into 2. There's experiences and there's activities. Disney is undoubtedly an experience. You have people who say, one of the things I want to do before I die is go to Disney World, right? Kids want to go to Disney World. It's an experience. SeaWorld used to be an experience. It used to be an experience because of the orca shows. That was within itself an experience that was kind of quintessential when you were growing up as a kid, getting splashed by the orca tail. I think with Blackfish and phasing out the orca program, you're looking at something that is now an activity. That doesn't necessarily mean it's bad, but I agree that it doesn't have the pricing power that an experience has. So theme parks, their activities, fairs, their activities. SeaWorld now is an activity. So I don't think we're ever going to go back to the glory days of SeaWorld being that quintessential once-in-a-lifetime experience that you'd get when you look at a company like Disney or a park like Disney. So for me, it's lost a lot of its power because of that. Of course, ethically, that's a good thing for people, right? After seeing Blackfish, I'm sure people are like, I'm never going back to SeaWorld because of that. So I don't think they should go back to orca shows, but without the orca shows, they're really lacking something.
Okay, so what about the stock going forward?
I think the stock has made a tremendous comeback from the lows where it was, but investing, as we know, is all about the future. And when you look at a business like this that I question its pricing power, and it's going to cost a lot of money to maintain these assets, which just means the balance sheet becomes more and more of a liability as time goes on. And in the face of questionable revenue growth, it's just not the kind of business I'd personally want to invest in.
What if I told you, to Emily's point, in trying to kind of re-inject that experience element, what if I told you, okay, work with me for a minute, SeaWorld, you add that show where the monkey rides the dog. Have you ever seen that, where the monkey rides around the dog and the monkey wears like a cowboy hat and bandana? Do they have the brand permission to do that? And I want to make sure the monkeys are like treated ethically and not separated from their mothers and all that.
In this age of technology, perhaps the answer really is just something more along the virtual or augmented reality side, where instead of actual orcas, perhaps they just have a hologram of an orca that sort of splashes on you, but doesn't really, right? I mean, you sit in those theaters at what is it, Universal, right?
Yep.
And
so virtual killer whales.
Maybe that's the answer, but then that really doesn't have the same. You leave wanting more.
How about if we pair virtual killer whales with very real monkeys riding dogs?
The monkeys thing is where you're kind of losing me on the monkeys.
Yeah.
I don't trust them.
Yeah, no, that's true. That's true. And you'd have to retrofit the parks, and then if they got out, there's liability. I haven't thought through this. I apologize.
Was it Joe Mager back in
true.
like?
I haven't really thought through this at all. I apologize.
Uncle
I take
Joe,
it back.
Joe Mager had like, didn't the monkey steal something from him like on his honeymoon?
I think
didn't that happen?
Yeah.
Joe, reach out to us. Tell us that story again if you can, Joe. If you're
they're crafty. I was in Gibraltar traveling, and they warn you, like, if you have ice cream, if you have any food items, the monkeys will come and they will take it. Yeah. So they're cagey. They're cagey. Okay. So as we wrap things up here, I want to give you my desert island poll. Again, if you've never heard this, you should never invest this way. It's completely arbitrary, and it's just kind of a fun conversation topic. You're on a desert island for the next 5 years. You can buy one of these stocks: Berkshire, Lowe's, Home Depot, we'll throw that in, or SeaWorld. What do you think?
Well, SeaWorld for me is immediately out of the question, just being a socially conscious investor, for better or worse. So for me, that question really just comes down to Home Depot versus Berkshire. And they're so similar but so different. I think I'll have to go with Berkshire on that. But I definitely think Home Depot is a close second.
Yeah, I used to actually own Berkshire Hathaway. I don't anymore. I think I'd go with Home Depot, actually. Ooh. I am just a big fan of that market. As someone who likes to do that work at our house, I mean, I think they'll be getting a lot of my dollars for hopefully the next 30 or 40 years. And so, yeah, let's go Home Depot.
And if Berkshire buys McCormick, you'll own Berkshire, right?
Well, there you go. Now you got the best of both worlds.
Well, there you go. Jason, Emily, thanks for joining me.
Thanks.
MarketFoolery@fool.com is our email. If you have questions, if you have comments, if you have any ideas on how SeaWorld can improve their experience or their activities, let us know. That's MarketFoolery@fool.com. Thanks for joining us. As always, people on the show may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Mac Greer. Thanks for listening, and we will see you tomorrow.